Okay, we are back, Chapter 7, page 5. So now we're going to review the impairment of accounts receivable. There is actually nothing new here in the next 3 pages that you haven't seen before. So it's just a nice little review for once. Okay, the book value or gross value of AR, the balance in the T account, is not represented, will actually be collected. And here we're going back to the value in AR is the gross value. So, short-term receivables are reported at their net realizable value, which is R minus AFDA. So, that's the amount that's expected to be received in cash. Make sure you know what net realizable value is. AR minus AFDA. So, as you know, we have to estimate uncollectible receivables and any future returns, allowances, and discounts. And it'll also affect the income statement amounts of bad debt expense, sales returns and allowances, and sales discounts. So this is yet another piece of saying how much are we actually going to get from our sales. Now, if all our sales were in cash, that would be easier. All you'd have to check for is returns and allowances. But this, we're talking about making sales on account. So, the problems exercises combine a number of these entries. So this is where we add the difficulty in. Make sure you use a T account or do the entries to keep track of the balances before doing the bad debts entry. Okay? So, the basic entry for bad debt, example 2, the entries. We debit bad debt expense, whatever it is, and credit AFDA or allowance for doubtful accounts. And this AFDA is a contra asset. Subtracted from AR. Now, in January, we received a bankruptcy notice from one of our clients, ABC Co., saying they can't pay the $2,000 they owe us. We have to write off their accounts receivable. So, obviously, we're going to credit AR for $2,000. But up here, we've put a bunch of possible doubtful accounts in here. We don't know who it is yet, right? Because if we knew who was going to be doubtful, we wouldn't sell to them in the first place. Okay, so we have to take it out of the AFDA pool. Think of it as a little pool for possible doubtful accounts. So take it out of AFDA pool as it's not doubtful anymore. So in this pool is only the doubtful stuff. This for sure, we know it's ABC Company and we take it out. So in March, client's lawyers notify us we'll be able to collect 30% per dollar of the debt owed. So, first, we put it back on our books. So, we debit AR and credit AFDA. So, we are essentially, that's an arrow, even though you can't tell, we are reversing this. Except we can't put the full 2,000 on, we have to put 2,000 times 0.30, which is $600. The second step is collect cash, which we debit cash and credit AR. So I know, you learned this a long time ago. It's going to come back quickly. So those are the basic entries. Okay, this is the entry for bad debts. You do it every month or quarter or year. So end of every, usually you do something at the end of every month, but for sure you do it very detailed at the end of the quarters or years. So this is the entry. This is if you have to write off someone's debt. This is if you have to put it on again to collect it. Okay, how to calculate bad debts. So we actually use the allowance method because it matches the expenses to revenue and follows the principle of conservatism. In essence, we're writing down AR every period for impairment, just like we would for goodwill or anything else that would become impaired. So on page 6, I'm going to start going through the methods, because of course there's more than one. This wouldn't be accounting without more than one method. Okay, so on page 6, 3 main approaches. The first one, the income statement, sorry about that, or percent of sales. So this method takes a percent of sales, net sales, or net credit sales, and that is the amount of the bad debt expense for the period. So you just calculate and put in bad debts entry. The AFDA balance, you don't worry about the ending balance. So let's just do a little example. During April, and I'm going to put net credit sales. Usually it's net credit sales, but it doesn't have to be. But it makes sense. You'd only calculate it on the sales you put on credit. Okay? If it's in cash, you don't need to calculate bad debts. So let's say your net credit sales total $200,000. At the end of April, estimate from past experience that 1% of those sales will be uncollectible. The balance in the AFD account at the beginning of April is $500 credits. Okay? So let's just write down our little AFDA account. And it's got a $500 credit balance, which is normal because it's a contra asset. Okay, so the entry to record bad debts is debit bad debt expense, credit AFDA, allowance for doubtful accounts. So this one's easy. This method, just take your 200,000 and times it by 1%, which gives 1,000. So that 2,000 goes right into here, and you end up with AFDA of 2,500. Okay? So your net realizable AR, how did we calculate that again? AR 200,000 minus 2,500. Oh, which is some number that I forgot to calculate. Give me a second. When I'm standing up here, even though you guys aren't even here, it's just too stressful to do math in my head. That's a secret about teaching that we try to keep hidden. So that's the net realizable value of AR. Okay, so that's the easier one. It's not as the back approach. So this is the focus. All it cares about is what's on the expense. Balance sheet approach focuses what goes into here and what this balance is. And again, you've done this, so it should feel a little familiar. Okay. So with this method, you figure out what the balance in AFDA should be by changing schedule of AR and then apply a percentage to each age group. So here's all the debts we have. Not our debts, our customers owe us, our accounts receivable. This is all AR. 37,000 not yet due, 1 to 30 days past due, and so on, and hopefully it keeps getting smaller. Now, then you have an estimate of percent uncollectible in each of these groups. Notice the older these get, the more likely they're not going to be collected. Okay? We'll give you those numbers if we want you to do that. And all you do is you multiply to get the percent uncollectible. 2% of these guys won't be collectible. And so on all the way down. Then you get a total uncollectible number. That's the total uncollectible, and this we adjust AFDA so that this is the new balance. Okay? This becomes the new balance in AFDA after our bad debt entry. So you can see how this is a little more specific. This has looked at the accounts and said, okay, these old accounts aren't going to pay, are likely to default more likely the longer they go. So it actually is kind of accurate, whereas this just said, we'll take all of it. Okay? So, so we want AFDA to be 2290. Assume AFDA had a debit balance of 100, because sometimes AFDA after your write-offs ends up with a debit balance. So we need to record the required journal entry. So we debit bad debt expense, and we credit AFDA. Sometimes this can be reversed. And the way you'd know is by seeing what you have to do here. So, what's the balance we want it to be? Well, we said 2290 from the last page. That's our new balance. Well, get it there. Do I have to debit the account or credit? Well, definitely I got to credit. I need more over here. How much? Do I do 22 minus 100 or plus 100? If ever you don't know, you guys, you just try it. So let's say we minused. So we got 2190. So if I put 2190 in here, and I'm just going to put it up here, is 100 minus 2190 2290? So we have to add it. So it's going to be 2390. So now 2390 minus 100 gives us 2290. So because we have to credit it, that's why we're crediting it. If we would have had to debit it, then this would have been reversed. Okay? Okay. That's the balance sheet approach. That's an aging. So you look at all your accounts, luckily on the computer now. You just print them off and it tells you how old they are. You can break it into whatever categories you want, 1 to 30, 30 to 60, or yes, 60 to 90 or whatever. Okay. So now let's look at the simple approach of the balance sheet method. It just says, you know what, aging is difficult to do every month. Let's just take a percentage of AR in total and then adjust the AFD account so its new balance will equal the calculated number. So it's just like we did, but no aging. So instead, what they do here, take an overall percentage and times it by the 49.9. So let's say it's 5%. 5% times 49.9, that would become the new balance, and then you do the entry for that. Again, that's not as detailed and accurate as this is because this spreads it out. This would just take a percent times the total and then adjust the new balance. Okay? Does that make sense? Now, there's also a combined approach. Some companies will adjust AFD and bad debt expense monthly just using a percentage of credit sales or a percentage of total AR. Okay? They won't care what's in, if there's an aging or AFTA, they just use one of these methods. So this simple approach or percentage of credit sales, the income statement approach. Then at year end, they'll do a full aging of accounts and then adjust the current AFTA balance. Okay? So, first or monthly income statement approach, or the simple approach, simple balance sheet approach. And then 2, a full aging and adjust AFTA. Okay, so you do that every month. Then you get to the end and you go, okay, here I've got a balance in AFTA and I've got my AR. So then I'm going to do a full aging and adjust it properly. Okay? So think this through, you guys. Accounting courses, as you go through now, are starting to think beyond just what you've seen. Okay? Because you're heading now to the CPA, those of you that are going, and everybody else, you're heading into the workforce. So you can imagine how, let's say you took over for an accountant or, an accountant assistant or something after you finish your diploma. And you looked at some stuff and it was something new, never learned. They were dealing with a specific case where returns were a certain amount, and so they were netting them out with something else. You have to be able to think and say, what are we trying to show? We are trying to show the appropriate amount of revenue on our income statement. They're doing something wrong, maybe they're not. It will be incumbent on you to look at it and go, oh my God, this doesn't look like anything we've done, and you'll stop and not panic, because that always happens when you first get into the workforce. Then you stop, you think about it, look at the transaction that's in question, and go back and look what they did to adjust it last year. Okay? Always, you guys, that's the nice thing about accounting, unless it's a brand new case, you can kind of do whatever you want the first year when you're learning. You can go back and go, what did they do